Good morning and welcome to the Velocity Composites PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and they can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I would like to submit the following poll. And I would now like to hand you over to CEO John Bridges. Good morning to you, sir.
Good morning and welcome everyone to our presentation for financial year ending 31st of October 2025. Hope you're well, and usual format around myself and Rob taking you through the headlines and the presentation and then picking up questions afterwards. So getting started, if we look, you see the headlines there, and we'll cover all the points and the reasons behind some of these numbers in a moment, and Rob will take you in detail through the financials. But essentially, revenue a little bit down due to some of the reasons that we'll discuss, but a lot of work gone on internally to drive gross margin, which again we'll cover off in a moment. And if we look at the year in review, clearly I think really 2025 industry-wise has been very similar to 2024 for pretty much the same reasons. Hopefully as we go into 26, we'll talk about that in a minute, some of these issues will clear, but in terms of the industry-wise, we're seeing the Spirit reacquisition by both Boeing and Airbus obviously clearing and a lot more clarity there at the sites involved. And for us, what that means is a lot of the sites we're engaged with were sort of paused whilst that activity was going on, in terms of any change activities. But again, as this clears, we'll look to pick those up properly now with the new owners. So that big sort of reason for distraction, if you like, industry-wise, has been cleared. Also good is to start to see the key programs like 737 MAX production rates start to increase, a little bit directly to us, but more importantly for a wider customer base to be busier, and obviously to get back to rates that were previously enjoyed and probably previously invested for by our wider customer base. And I think as well, we talked about defence. Defence, we're starting to see procurement activities ramp up and move from planned rate increases to real rate increases, and again we hope that'll flow through down to our supply chain and our customers as those kick in and move from planned increases to real live production increases. I think in terms of key programs like A350, we're seeing production rates pretty much flat through 25 as they were in 24. And as you may remember, we as an industry were looking to ramp up in 24, and we're still expecting that to happen. And Airbus is still buoyantly talking about rates 10, 12 in the not too distant future. So again, 26, we are starting to see customers look to get ready for those sort of rates and the ramp up activities involved. Looking forward into 2026. I think it's a word that's been missed for a while, but optimism does seem to start to return, certainly to our customers as they look forwards and these rate increases and defence production increases into 26, which will of course be beneficial. As we say, the distraction from the Spirit reacquisition from some of our customer base will clear, and we can start to get back to some of the activities we were prior to that, probably 2 years ago now. That defence sector lag, we're starting to transition into real volume increases, and again we'll look to those certainly through 26. And as you know, we have sites in Europe, in the UK and in the US as well, and wanting to capitalise on the capacity that we have in those sites, not only on the existing contracted business as that ramps, but also new business as that flows through. Although we do see some little sort of changes with some of the customers as they move from sort of legacy programs and transition forward into their sort of new volumes. And also one customer that's looking to move some production from the UK into mainland Europe. So again, we'll talk about that and what we're doing to support those customers and hopefully follow that work. But again, it does mean changes in the sort of local portfolios going forward. Thanks, Rob. US operations. So as you know, we've been delayed for a little while now on the transfer of one of the key programs from our launch customer, not to do with Velocity or Velocity services, more an issue between our customer and the OEM customer, which has delayed any change activities. Latterly, we're starting to see that clear finally, and a lot more positivity from our customer and the OEM in terms of the transfer of that key amount of business in this year, and actually discussions with the customer about how we can support the sort of recovery and the ramp beyond previous volumes to support the wider program going forward. So I think that's been finally a resolution comes to that package of work, and we'll see those volumes through in 26. We have actually started to engage at a lot higher level with that and other customers. So our launch customer in the US, that's clearly, communicating the impact this has had on us, and our business, and investors who funded the key US facility and the business that comes with it. So we've actually engaged at a much higher level, and that's obviously been fairly well received, and we've got a good plan and relationship going forward to not just get that original work contracted, but also look at additional business from that site that it's won in the meantime, and also the wider group, and leverage our performance and the relationship to assist that customer in the sites it has both in the US and in Europe. I think this wider industry optimism has meant that we can really step up and move new business activities from the sort of development and bid phase into serious engagement now as we look to close those relationships. And we've made a lot of progress in the US, some of which was delayed by the Spirit Boeing Airbus reacquisition. But the sort of good news is we have a good relationship with what will be our second customer in the US, part of a wider group, and we'll be announcing progress in due course there. But again, as we've already talked about, there is capacity in the US facility, and the investment has already made to deliver not just the existing business, but also additional business too. So clearly, we want to utilise that investment and that capacity to deliver both on our launch customer and subsequent customers going forward. And then in Europe, through the year, we announced a contract renewal with our existing long-term defence customer earlier in the year. Again, it's been long-term business on key programs, and also a 10-year extension, well, pseudo extension really. We've been doing some launch programs with that one customer site, and what we have now is a 10-year agreement for all the business on that site, and we're currently in the process of transferring that into our Burnley facility. So again, good piece of work, obviously long-term work, and on a key growth rate platform as well. And I think it's probably again more sign of customer optimism looking forward. That program's been around for we've been engaged with that customer for to 8+ years now, and again only now do we post-COVID and post all the disruption and ramp up delays, I think the optimism in the industry means that people are looking forward and signing these long-term agreements on key platforms. As I mentioned earlier, we have got a couple of UK customers that are going through a little bit of change, two very different reasons and activities. One is a customer who's looking to move work from the UK into Europe. And again, the full details of that have yet to be announced by the customer. But we're working with that customer to understand what that looks like. We've sort of got a reasonable picture for 26, but sort of 27 and beyond, we're engaged with the customer. We would clearly look to follow it using our forward stock location model. But as of today, we're just sort of flagging that change is coming. As we also know, as clearly we all know, transfer programs can morph over time, but we remain close to the customer, support them in that, and we'll obviously support them wherever that full portfolio ends up in their organisation. And then the second customer, mainly on legacy programs. Those legacy programs have moved from the sort of volume production to spares and repairs type production, and the sort of residual other programs with that customer, some of which they're looking to inload just to fill capacity within their facility. Again, neither of those two activities are commercially driven. We've been, clearly stated to that by the customers. It's not about, what the quality of Velocity's products or the commercial offering of those products. I think it's just, looking at the, particularly with the legacy side of things, there are a lot of customers with spare capacity, and how they fill that across all their plants across Europe and beyond. They're looking to do it in any means possible, and certainly one of the customers, the small amount of Velocity business that's looking to inload is part of multiple inload programs across all their value streams, like sheet metal and and others, just really to bring as much work back into that fairly poorly underutilized facility, shall we say. So again, we'll manage that with the customer. We'll look to work with them and maintain as much as we can. Clearly, we've still got the spares and other business with them, but we'll balance that along with the new business work to offset it. Thanks, Rob. I'll hand you over to Rob, who'll take you through the financials.
Yes, good morning, everybody. So I'll do a fairly high-level summary of what's been going on with the financials. As John mentioned, revenue was down in the year, 23 million down to 20.7 million. It's 10% decrease. However, you'll notice the gross profit actually increased, and that is as our gross margin went from just under 26% up to 29.5%. So our gross profit improved by well over 100,000, 140,000 pounds. So despite the lower sales, we're in a better position on gross profit. Our administrative expenses were flat on the year and actually trending down, and we've identified further areas of cost reduction. We actually implemented some savings in the back office right at the end of FY25, which will benefit from a full year savings of through FY26. This was in no small part due to us migrating our internal ERP system to an Odoo-based system, whereas our legacy systems required quite a bit of manual intervention. Most of the systems now are fully integrated and tie up between functions, so we've been able to reduce our headcount. Operating loss improved in the year. Clearly, the drive is to get that to a positive, but we have made good progress to get that going in the right direction. And we also reduced our finance expense during the year. So year on year, a reduction in loss before tax, and more significantly, we actually improved the adjusted EBITDA. So we moved from just under 400,000 EBITDA to just a smidgen under £1 million EBITDA. So good performance operationally, but clearly we need the revenue to grow to start to generate full profitability. Moving forward, looking at the balance sheet, non-current assets did increase during the year. That was investment in capitalisation of R&D activities. This is process developments which are ongoing within the business to become more efficient. And also we invested in a freezer store in the US. This is a very large freezer store because most of our raw materials have to be kept at frozen temperature, and finished goods, whilst they're on the premises, need to be frozen as well. Inventories reduced. That was in part due to the lower sales, but more to do with the fact that margins have improved. So the profit we're making on each pound of inventory is improving, so you need less inventory to generate the same amount of sales. Trade receivables came down. That was as an effect of the lower sales, but also an improvement in our debtor days. We've moved down from 53 days to 44 days, and those both inventory and trade receivables we continue to work on to get the best efficiency out of our balance sheet that we can. The current balance of the CBIL loans is 400,000, down from 500,000. We're now into the last leg of the repayments on loans. So we've moved, and we've got 100,000 in the long-term period portion of those CBILs, but long-term means the first half of FY27. So by this time next year, we will be more or less debt-free as far as the CBIL loan's concerned. Trade and other payables came down, mainly as a result of the reduced sales, but again, due to the improvement in margins. Clearly, if you're buying less inventory, you're owing suppliers less money at any one time. Obligations under finance leases increased. This was as a direct result of the US freezer store. So under the world of IFRS, we capitalise those leases and we show the obligations under finance leases, both the short-term element and the longer-term element. Moving to cash flow, the business generated cash from operations. You can see the net cash flow from operations was inflow from operations of just under £1 million, and that shows that the underlying business is cash generative and profitable. Where the money is going is investing in investment activities. That's the freezer store, R&D capitalisation and those things, and financing activities, which is the repayment of the CBIL loans, interest charges, and lease obligations, which are being paid. Overall, a net decrease in cash of 1.2 million, leaving us with a cash balance as at the 31st of October of 400,000. Taking off the remaining CBIL loan, that left us in a net debt position of £100,000. But I should advise you that we have an invoice discounting facility. The total value of the facility, if we could draw down on all of it, is 3.1 million. So a significant amount of headroom. At any one time, we'll be able to draw down circa 1.5 million of that. So there's a good amount of headroom. I would also comment that one of the things we're required to do, as are all public company businesses, is look at our whether we have a going concern status, and we review our forecast going out over a period, and we look out over 2 years, and we've done a lot of modelling and testing, and in each of those tests we confirmed that we meet the going concern status, and we're able to sign the accounts off as going concern, and that's within the existing cash and facilities availability. I'll hand you back over to John now, who will summarise.
Thanks, Rob. So again, looking forward, clearly completing the transfer of the business with our launch customer in US is key. And as I mentioned earlier, we've seen a different support level there from the beyond the site, with the senior leadership of that organisation, and utilising that both at that completing that transfer and also on other opportunities where we can work together to grow and support that customer, and then really manage those work transfers that we talked about, and program supporting with the customer to see where Velocity can support wherever that business is manufactured from. Supporting, being able to respond to those sort of, both new existing business and new business opportunities is utilising, as you mentioned before, the capacity in our existing facilities, but supporting customers by forward stock locations. These are much smaller, sort of scaled, either freezers or support structures on site with customers, where much more lower investment than having a full production facility. We have production facilities with capacity, so the forward stock locations allow us to work with customers, like we are with the second customer in the US and the sort of big customers in Europe, to actually support them closely by the forward stock location, but everything manufactured centrally where we have the know-how, the capacity and the infrastructure. So that's what we're looking to sort of implement going forward. And also that's supported by our VAMOS. Again, if you look at our previous way of working, where we'd sign an agreement and then we'd have to wait for the sort of transfer to complete, and our customer would have to wait for the transfer to complete for the benefits to flow. With VAMOS, it's much more of an immediate transfer of initially the sort of material management side of things, where the customer gets a benefit, we get revenues, and everyone's on a much more sort of driven transfer program. And if that does get curtailed for whatever reason, there's revenues there already, and benefits for the customer as well. So we are sort of tweaking those services as we roll out into new customers served from our hubs. And the cautious optimism of the industry is perfect. I talk about it in the annual report about the sort of environment for customers to take up the business cases that are on offer as they grow, as they get busy, and really focus on customers who are growing on growing platforms, geographically stable, with diverse portfolios across civil and defence, is what we're focusing on as we expand both in Europe and North America. I think that covers the main bulk of the presentation. So I think what we'll do is we'll go straight to the questions. So question one, in terms of augmenting the sales effort. Yeah, I agree. It's a relatively small team, but again, our customer base and potential customer base are relatively small numbers, and we are focusing now at senior level engagement rather than site level engagement. We sort of recognise that sites have their timescales and priorities, but what we offer really is of interest at the corporate level, where the cost savings, the inventory reduction, and the cash that inventory reduction frees up is really more suited to the sort of corporate level. So yeah, it's a good question. It's something that we review very frequently, in our board meetings, and I think there will be some updates there through this year as we sort of ramp up that senior level engagement to turn these costed business cases into contractual agreements. It looks like question 3 from Paul L.
Financial question. Should I address that?
Over to you then, Rob. Yeah.
Right. So as I mentioned when we went through the balance sheet, so thank you, Paul L, for submitting the question. You comment on the inventory and trade payables coming down from FY25, from between FY24 and FY25, and what the flow of that is going through FY26. Now, you'll appreciate we can't comment on FY26 because it's not in the public domain, other than I'll give you a flavour for what's going on. So FY25, and we continue to bear down on inventory and push up margins. So one of the big reasons why inventory came down was an improvement in margins. As in margins improve, you need to buy less inventory to get the same sales. How the first 3 months of FY26 has progressed, as I say, we can't comment on that specifically without advising all investors at the same time. However, there is a weighting through the year as the transfer of programs in the US on that lead customer comes through. As John mentioned, we currently got about 40% transferred. We're expecting to get the majority of that work transferred by the end of the year, and it transfers during the year, so there will be a second half weighting. But the drive on inventory and receivables continues. We would look to get more and more out of the balance sheet that we can. John?
Thanks, Rob. Question 4 from Daniel B. How much of the FY26 revenue is contractually committed? Without an exact number, the sort of most of it really, if not all of it, Rob, is pretty much contractually committed. And when, again, looking at production rates, we've erred on the side of caution there, and sort of assumed fairly flat production rate year. And as I'm sure you appreciate, a lot of our forecasting is based on the forecasting from our customers as well. So we've taken a relatively prudent approach, but again, as Rob says, was the big transfer from the US, and getting that done is an important part of that, which we have a lot more confidence around, and have a committed timeline with the customer. And anything new to that will get updated to the market accordingly.
So back to Paul and more financial questions. First question is about going concern modelling, and you asked, does this assume full use of invoice discounting facility? So one of the things we have to do is a thing called a reverse stress test, which says at what point does your cash run out if you reduce in the sales level. So we've modelled that if we reduce sales down to 75% and make no other mitigating cost savings, so it's a conservative number, cash would run out if we were at 75% and nothing else changed. That does assume full use of the invoice discounting facility. This is a very highly unlikely scenario, and is part of the modelling exercise we have to do to get the accounts through the audit.
I think we missed a question, Rob, actually.
I think so.
On key milestones.
Oh, sorry, we did miss a question. Yeah, we'll go back up to Chris L.
Key milestones, I think, as we talked about, obviously getting the US project complete delivers that, and then really turning some of the live business cases and the activity that's already been completed and sat there with customers into contracts. And again, as the industry sort of begins to ramp up and get busier, that's the feeling is certainly that the ability to do that will greatly improve, because we've seen that some customers, current customers, as we've seen, are not that busy and on different programs, whereas all our focus on new customers and growth customers are on ascending programs, but also on a diverse portfolio. So that's where our focus will be, and as we move through those, that's obviously delivers the sort of what's asked in the question there, but even just delivering what we've already contracted gets us to that position. Going to grab the mouse just so I can see that. you answered that one. No, sorry. That's the next one.
So, again, Paul, I'm trying to interpret your question. I'm not certain I fully understand what the meaning of it is. So I believe what you're asking is, have we included increased production from our US site from the contracts? And the answer to that haven't transferred yet, yes, we have. It is through the year and is at the latter point of the year. So that comes in later in the year. There is some runoff on legacy program. There is runoff on legacy programs in the UK, which we factored in. So the guidance that's in the market for FY26 does take account of those activities. Yes, there is a process for qualifying production which transfers to us, and we are in process on that at the moment. It's called first article inspection, and we are going through that, and we're on a timeline that's been agreed with the customer, which transfers the work in during the year.
Thanks, Rob. Question from Simon G. What share of the business does through the US plan? Rob, you've got that number probably?
Yes, it is. So through FY26, the US plant becomes the larger of the two plants as the work transfers in from our lead customer, and the legacy work starts to dip off in the UK. I believe it's about 55% US, 45% UK. There's a subsequent question on the European customers.
You mentioned the European customer.
So we've assumed no revenue to mainland Europe in the current market forecasts which are out there, and we see that will be a case of ramping into FY27. We haven't indicated FY27 numbers as yet because there's quite a few moving parts of the jigsaw which we need to close out over the coming months, and we're looking to put guidance out at the half year in sort of 3 months' time.
That's great, Rob. John, if I may just jump back in there, as you have addressed all the questions from investors today. And of course, the company can review all questions submitted today and will publish those responses on the Investor Meet Company platform. But John, before I redirect investors to provide you with their feedback, which is particularly important to the company, could I please just ask you for a few closing comments?
Yeah, thank you, and thank you everyone for joining us. As we say, it's 25. We hopefully see the end of the sort of post-COVID malaise really in the industry. We've seen a lot more cautious optimism with our customers. We have, as we mentioned, progress in the US with the second customer, progress in completing that key transfer of work with a key customer, which we want to utilise that relationship in Europe as well, and really move some of these business cases into the from the engagement stage into the contractual and delivery stage, because again the services are needed and will be even more needed as customers get busier and need to meet some of these challenging rate increases.
Fantastic. John, Rob, thank you once again for updating investors today. Could I please ask investors not to close this session, as you will now be automatically redirected to provide your feedback in order that the board can better understand your views and expectations. This will only take a few moments to complete, and I'm sure will be greatly valued by the company. On behalf of the management team of Velocity Composites PLC, we would like to thank you for attending today's presentation, and good morning to you all.